Let's look at the benefits, the advantages of balanced funds. Um, Balanced funds actually have some worthwhile advantages we should consider. So balanced funds, offer several advantages, especially for investors seeking a diversified and less volatile investment options. And so here are, the advantages you want to consider in this video. Number one is on diversification. Diversification. You discover that unbalanced funds, invest, in a mix of asset classes, typically, stocks, bonds, you know, commodities, real estate, providing that built-in diversification, that inbuilt diversification. This reduces the risk of putting all your money into a single asset class, which can be volatile, like stocks, compared to putting your money in stocks and bear volatility. It's better you go for this balanced fund, though with a lower returns, but at least that safety is that risk mitigating factor is there. Number two is a moderate risk and return. Moderate risk and return. Some balanced funds invest in both equities, which offer growth potentials, as well as fixed income, like bonds, which provide stability. They tend to offer a moderate risk and return profile. This makes them ideal for investors who want to avoid high volatility of a typical, pure equity funds, but still seek the high return potentials of a bond only fund. All right, so you have the return of a bond only fund, and you avoid the volatility of an equity only fund. It's a very interesting balance, actually. Number three is income generation. Income generation. You discover that balanced funds often provides a regular income stream, through dividends from stocks, as well as interest or coupons from bonds. So they tend to have it both ways. So this makes them appealing to income-focused investors, such as retirees, who would prefer to have regular income to support their living standard in the absence of a salary. Number four is automatic rebalancing. Rebalancing is placed on autopilot, actually. So in this case, many balanced funds automatically rebalance their portfolio, to maintain a predetermined asset allocation. Generally, it might be 60% stocks or 40% bond, depending on the prevailing market circumstance. It could be 60%, bonds, and even 40% stocks. It all depends on the discretion of the fund manager and based on the prevailing market's returns. This ensures the fund stays aligned with the investor's risk tolerance and long-term goals, without requiring the investor to monitor or adjust the portfolio. Number five is convenience. It offers convenience, actually. So balanced funds offer a one-stop solution for investors seeking diversification across multiple access. It's kind of, a one-size-fits-all investment. You want to diversify across different asset classes, buy a balanced fund, because already in their portfolio, they have most of these asset classes, embedded therein. So instead of having to manage individual investment in stocks, bonds, and other assets, investors can rely on the fund to handle asset allocation and diversification. So it's very simple. It's a straightforward, kind of arrangement, and it is convenient. Number six is professional management. Professional management. So many balanced funds, are actively managed by experienced fund managers. They have the experience, they have the skill, they have, the 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 know-how actually to be able to produce uh, expected result. So they make decisions about asset allocation, about the stock bond selection, and they equally consider market timing. This can be beneficial for investors who may not have the expertise or time to manage their portfolio. You want to generate returns and you don't have the expertise and you don't have the time, this investment is for you. And I'm telling you from experience, it takes real time to develop expertise in investing. I've been investing for the past 18 years. Out of the 18 years, I spent 11 years learning. 11 good years. So if you don't want to really go through the route of the years of learning and you still want to invest, you can go through a balanced fund. For me personally, I don't do I don't invest in mutual funds. I do stock market investment directly. I like it that way, at least I have control over what I buy and what I sell. And I'm fully accountable, for my result. I cannot blame anybody for whatever goes wrong, you know. That's by the way. Number 7 is suitable for long-term investors, you know, suitable for long-term investors. So balanced funds are typically well suited for long-term investors who want to grow their capital while maintaining a reasonable level of risk. The blend of stocks and bonds provide both growth and stability, helping investors ride out market volatility over time. So you have that growth, through stocks, and you have that stability, through bonds. So you'll be able to cope with market volatility over time. Number 8 is lower volatility than equity funds. In equity funds, that are stock-only funds that invest in the stock markets are known to be volatile. Depending on how volatile the market is, their portfolio will the volatility will be equivalent what's obtainable in the markets. If the market is very volatile, the stocks in your portfolio will be volatile as well. And so balanced funds are generally less volatile than pure equity funds due to their bond allocation. The bonds provide a stability, it provides a kind of stabilizing effect, stabilizing influence during period of stock market downturns and reducing the overall risk. Number 9 is flexibility. And we discovered that bond funds cater to a wide range of investors, varying from risk tolerance, risk tolerances, from moderate risk investors to those close to retirement who would want a more conservative approach. So it's flexible. Those who are about to retire or who have retired can equally invest, and those who cannot really stomach risk, cannot bear high risk, can equally invest in a balanced funds. And so they can be a good solution for both aggressive and conservative, investors, depending on the fund's asset allocation, depending on, how their fund allocate its assets, how many percentage to bonds, and what percentage to stocks. Then number 10 is cost effective. It's a cost effective kind of vehicle. While actively managed balanced funds might have higher expense ratio than index funds, they are generally more cost effective than building a diversified portfolio of individual stocks and bonds. You want to buy different stocks. You want to buy different bonds. It's cumbersome, actually. It's cumbersome and it's not cost effective. But if you buy a balanced fund, then these balanced funds do what? They invest in all these securities. So you don't have problem tracking your portfolio, and you don't have problem with rebalancing. Everything is just done automatically by the balance fund. These advantages makes balance fund a compelling choice for investors seeking a diversified portfolio with moderate risk, long-term growth, and a consistent income stream. It's a very good investment for those in this particular category.